All right, great. I'm real excited for our presentation today. This is a topic that's really trending uh, with a lot of interest. We're getting a lot of questions from our clients about it, and we're very blessed to be able to have an author on the subject and a very knowledgeable individual on the subject here to share with us. So without further ado, let me introduce to you one of the co-authors to your Essential Guide to Sustainable Investing, Sam Adams. Sam describes himself as both an environmentalist and a capitalist. An avid climber and skier, he is passionate about nature and enjoys spending time in it and believes in defending it. 20 years ago, Sam worked to develop investment products which helped to revolutionize the investment industry by allowing those investors access to lower cost funds offered through commission-free advice. At first, people thought the idea was crazy, but the market eventually responded to a better way of doing business. Today, Sam believes that we're looking at another revolution. With an increased focus on environmental, social, and governance issues, capitalism promises to be more balanced in its pursuit of the triple bottom line for people, planet, and profits. Sam feels so strongly about these changes that he founded Vert Asset Management to enable investors to accelerate the transition to a more sustainable capitalism and benefit from it as well. Sam is the graduate of the University of Colorado in Boulder, where they hardly have any nature, and earned his MBA from UC Davis Graduate School of Management.
All right, excellent. All right, so we introduced Sam, and then he cut off the line. So how about we're gonna try to introduce you. Hopefully, you can stay on with us.
Yeah, hopefully that's the case.
Right, hopefully, this is not the curse. So I am now going to introduce Larry Swedroe. Larry serves as the Chief Research Officer of Buckingham, where he spent his time, talent, and energy educating investors on the benefits of evidence-based investing. Larry is a well-published author. He was among the first to publish a book that explained the science of investing in layman's terms. The book was called The Only Guide to Winning Investment Strategy You'll Ever Need. He followed that up with 7 additional books that he's added to his personal resume, and he's co-authored 8 books about investing. Larry's dedication to helping others has made him a sought-after national speaker. He's made appearances on national television shows on NBC, CNBC, CNN, and Bloomberg Finance. Larry is a prolific writer, contributing regularly to multiple outlets, including the Advisor Perspectives and the Evidence-Based Investor. Larry holds an MBA in Finance and Investment from New York University and a bachelor's degree in finance from Baruch College in New York. Larry, welcome. Sam, we're getting back to, and we're ready to roll here. So Justin, I'm going to turn it over to you to—
Sam's climbing that mountain up there. That's why he keeps there.
No wonder he's got bad service.
After a little bit of a bumpy start here, like the mountain, Justin, I'm going to turn it over to you. You can ask the first question, and we're going to work with Larry while he's here, and then Sam can jump in with his thoughts.
Great. Larry, just thank you so much for joining us today. Massive fan of your books. The Complete Guide to Retirement is a wonderful resource. So just thank you for that. Today, talking about sustainable investing and talking about ESG, environmental, social governance, means many things to many people. Some would argue it's just become meaningless and kind of a buzz term. So how does an investor sort through the noise to find an investment that really matches what they want and desire?
It's a really good and broad and not easy question to answer. That's why Sam and I wrote the book. The first half of the book, which is mostly Sam's effort to help investors try to understand this whole area of ESG and the history and how it evolved. And unfortunately, one of the problems is there are no great definitions for exactly what is ESG and what is not. And even in the research, there's different different definitions for the terms. Let's see if I was hoping Sam would be, able to join us by now. So he would answer this question in more detail than I can. But let me say it this way. We started out with what was negative.
Can you guys hear me?
Yeah, now we can hear you. Sam, if you want to take over, feel right ahead, maybe kind of brief history of the movement.
All right, sorry about that. I think the heat wave in California is messing with our internet, but that's just a theory I have. So when we wrote the book, we decided to put ESG, SRI, and impact in the title of the book because there are very different ways of investing for sustainability, and we think you can group them into these three different categories. Unfortunately, explosion in interest in sustainability is that people are not using terms to describe sustainable investing consistently, and so there's lots of confusion.
Well, not only is there a lot of confusion, there's a lot of technological issues.
Yeah, that's unfortunate.
Can you guys know?
Yeah, we got you back, Sam.
Okay, I won't start the video. That seems to be causing a problem. So the difference between ESG and SRI and impact are the following. SRI investing is probably the oldest form, and it goes back hundreds of years. And this is where religious investors or deeply ethical investors would say, I want to invest for a total return, but I have some no-go areas. I don't want to invest in tobacco or alcohol or pork or gambling, or now we call this group the sin stocks, tobacco, alcohol, gambling, pornography, weapons. You have Catholics avoiding abortion. There's all kinds of different ways to invest for personal values. And we kind of characterize that as a balance between pursuing financial return and your own values, right? Because you're willing to make some trade-offs there. You don't care what tobacco stocks do, even if they're going to be high performing, because you just don't want them in your portfolio. And then there's impact investing, which is really a for-profit version of philanthropy. That's taking money and putting it into a problem area, usually a specific location or for a specific group of people, and saying, I want to alleviate this particular issue. I want to create drinking water or better education or, solar panels and energy in sub-Saharan Africa or something. And so that's really more like private equity or private placements, difficult to do, and similar returns, either like really high or really low. And then there's ESG investing. This is the most recent entrant to the field. It's only about 20 years old. And ESG investing is about taking data on companies, environmental, social, and governance data, and then emphasizing companies that are doing better and maybe de-emphasizing companies that are doing worse on their environmental footprint, their social influence, and their corporate governance. And so the ESG investing can be done in a way to get market rates of return. It can be done in a way to try and affect the entire system rather than just pick out a few stocks. And for that reason, it's been the most popular. Over 90% of the money invested for sustainability is now in ESG. The biggest pension funds in the world are embracing it. The biggest asset managers in the world are embracing it, and more individual investors are embracing it as well.
Sam, why don't you touch briefly on the difference between negative screening and relative screening?
So negative screening is characterized most obviously by that traditional SRI exclusion. You're saying, hey, you know what? I have cancer in my family. I can't have tobacco in my portfolio. And you can do that with ESG as well, or impact investing. You can say, all right, we're not going to invest in old school oil and gas companies. We're just going to take them out of the portfolio. And sometimes they take out entire industries, entire sectors, and you can imagine that might have some not so good effects on your returns. Now, a different way of approaching sustainable investing is relative weighting, and saying, hey, let's overweight the good guys and underweight the bad guys, to use a highly technical term, right? Which is saying, we're not going to exclude all oil and gas companies. Maybe we'll include the ones that are transitioning fastest to renewables. Maybe we'll only exclude the guys that are dragging their feet in this transition. And maybe we'll just underweight those guys to let them know that we're penalizing them in some respects. So there's more sophisticated ways of weighting your portfolio towards sustainability than just outright exclusions these days.
Yeah, I would just add this, what we think is a really important point here on this issue. You have to think about, and we have a whole chapter on the book about the impact ESG, SRI type investors are having on companies their financial performance and also their stock prices because of their behavior when they select stocks or exclude them. So what you need to be aware of, if you exclude companies, obviously by definition, there are fewer buyers of their stocks. All else equal, the stock price will be lower. They'll have a lower PE ratio, higher cost of debt if investors won't buy their debt. And that will put them in a situation where they have a higher cost of capital and they'll be less competitive in the ability to make investments because they'll have higher hurdle rates to meet that higher cost of capital. So that you may think that's good in that you penalize, of course, companies you don't want. But what many investors don't know is, for example, the industry with the most green patents is the energy industry. And there are a group of companies like Total Petroleum that Sam mentioned that are very active in this transition. They say we're going to exploit the brown assets we already have, but we won't make any new investments, and we're going to take our capital and deploy it in this transition. So if you exclude them, you're making it more difficult for them to make investments that allow for that faster transition. So we think the right strategy from that perspective anyway, is to have a industry weighting. So you score companies relative to their peers in the industry, as opposed to an absolute score relative to all companies.
It's really fascinating. Thank you, gentlemen. Along those lines with the relative weighting, is it possible for you to have a company that is good in one area but bad in another and leave you as an investor conflicted? I'll give you an example. What about a solar company that's based in Saudi Arabia? Would that be a good ESG investment, or is that a bad ESG investment?
I'll kick that off and then let Sam jump in. So first of all, this is where there's a lot of confusion, even in the research, and it's difficult to draw conclusions. And you'll have to make sort of a lesser of evils decision about how you go about deciding which companies to exclude or not. So for example, I'll just make this up as a simple example. So you have ESG, and there are 7 major raters. Morningstar is one of them, Sustainalytics, bunch of others. We describe them all in the book. And maybe one puts an equal weighting, 1/3 weighting on the E score, 1/3 on the S, and 1/3 on the G. Somebody else decides 70% should be the weighting on the E, 20% and 10, and a third has an entirely different scoring. And then within those categories, I'll just pick one as an example. Let's say you want to look at diversity, and one says, we're going to score that by the number of women and minorities on the board. Another will say, we'll score that by the number of women and minorities in management. A third will say, we'll look at it by pay gaps or some combination. So if you look at academic research, you have to decide and understand which rating and weightings did the researcher use, and would you get the same results if you use Sustainalytics versus Morningstar's ratings. So it can become very difficult unless you have the resources to do the due diligence, uncover that, or what you can do is work with an advisor and build your own unique portfolio that says, these are the companies I want to exclude or not. But it's very difficult because we don't have one standard. And I'll let Sam, he does a good job of discussing the pros and cons of this issue of, do you want standards or not even?
I think you don't want, you want standards around data, right? We'd like all of investors community to have public available information like the greenhouse gas emissions of a company. But this idea that ESG ratings could describe what a good company versus a bad company is It's kind of like saying we could do an NFL combine and decide what a good football player is and what a bad football player is. And we're not going to look at positions. We're not going to look whether they play offense or defense, or whether they're a punter or a kicker or a quarterback or a receiver, right? So you say, all right, this guy's 5'7", weighs 140 pounds. There's no way I'm going to put him on a football team. And you're like, yeah, but he can punt the ball, 80 yards, right? Okay, well, we shouldn't pay attention to his weight and height statistics. We should pay attention to his punting ability, right? And we don't really care about his size. And so I describe the ESG era into three categories. ESG 1.0, where you had these rating agencies like Larry's talking about, Sustainalytics and MSCI, who try to give you a number or a letter and say, this is a good company, this is a bad company. We've moved past that. I mean, a lot of funds are still run that way, but you can't boil down the complexity of a company into one number, right? No company is good and no company is all bad. And so what you need to do is decide what the role is the company's playing in your portfolio, and then evaluate it on what's most material to its business. A mining company, one of the things that's really important in mining is health and safety, right? That's a big driver of their lawsuits, their reputation, their costs. But in a bank, right? What, we got to get a paper cut or something? I mean, it's really not. Health and safety of the employees is not really an issue. Cybersecurity might be a bigger issue where it might not be for a bank. And so the new era of ESG investing is saying, let's look at what's most material financially and from an impact perspective for these companies, and then we'll put them in our portfolio, right? So by moving away from this idea that we can rate a company and picking its actual position in your portfolio, you could actually field a decent, let's call it football team, and you say you get the best punter, you get the best quarterback, you get the best receivers, because you're paying attention to what they can do on your team. Same thing. You want energy companies in your portfolio, you want mining companies in your portfolio, you want consumer products companies in your portfolio, and let's choose the ones that are good at what they're doing.
Yeah, I'll give you one other example that's related and shows you how complex an issue is. So someone could say, we don't want to support mining companies because they destroy the earth. In their mining, they not only destroy the landscape, they pollute the water and all this kind of stuff. And then on the other hand, where do you think the lithium and other rare metals come from to create the batteries so we can drive electric cars and that go into windmills and other things, right? That's why this is a somewhat complex problem, and why we think it is important to look at it by industry, or what you might call a best-in-class approach, rather than just screening certain tire industries out.
Yeah, I think that's a really great way to go about it, in terms of, without just saying, they're bad, don't invest. Say they're in an industry that may be bad, but they're one of the top players in it and most sustainable in it. So let's overweight them and underweight, or maybe even exclude, some of those worst in class players. I think that would be a much better way to go about it, in terms of maintaining some diversification. Because if you really want to invest sustainably, and then with the best governance and with the best social environment, you're going to eliminate companies very, very quickly, until you have nothing to invest in, because nobody is good at all things.
By the way, Justin, the fund company, Dimensional Fund Advisors, that's exactly how they build their highly diversified ESG, or socially responsible or sustainable funds, is through that best-in-class approach.
Perfect. That's why we're a fan. So let's talk about that in terms of implementation, because obviously, the people on the call can work with us, work with an advisor to implement this strategy. But a lot of people have their money tied into 401k plans through work. And a lot of those don't offer these types of investments, at least yet. Do you see that changing, or how do people access these investments when their 401k doesn't offer it?
Sam, you want to take that?
Sure. Well, that is the situation for the majority of 401k plans, is that they still only offer standard or conventional funds, but that's changing quite rapidly. Our fund, we have a Global Sustainable Real Estate Fund that Dimensional is a sub-advisor on, is in over 75 401k plans now, and those have all been added in the last year. So it's changing rapidly as employees go to their companies and say, we like these. And as companies realize that there are ESG strategies that don't compromise on risk and return. See, the what's called the fiduciary standard and the responsibility of a 401k plan is actually quite high. And so these guys need to be really careful when they put funds into a plan that they're not going to compromise on financial outcomes for the employees of the plan. So it's a bit harder task to add ESG there because it's not a personal choice, right? It's a choice for a group of people. But having said that, with all the options available now, you're seeing these changes come more rapidly, and there are even ESG target date funds and things like that that can fit into these plans quite nicely.
So we've gone for a good 20 minutes or so in this discussion here, and there's a word I haven't heard used yet, and that's profits. Are profits and socially responsible investing mutually exclusive?
Let's see, I'll take the first shot at this one. So clearly they're not. The question is really from the investor's perspective, should I expect to sacrifice returns in order to express my values? Is there a trade-off? If there is a trade-off, then you could make that decision based upon either 100% on your values and said, it doesn't matter what that sacrifice in expected returns is, that's the way I'm going to invest. Somebody else might say, I'm only a profit seeker and I'll use those excess returns that I get by investing in sin companies, and we'll touch on that, and donate to the causes I believe in the most. And then there's somewhere in between those where someone would say, I'm willing to give up a certain amount to express my values, but beyond that, I would not be. There's no right answer. It's a personal one. All right, so now let's talk about the economic theory and what it has to say about sustainable investing. And then we'll talk briefly about what the academic research is. We have a whole chapter citing about 6 academic papers that have looked into this subject. So the first principle in finance is if a number large enough group of investors screen out entire industries or companies, then obviously the price will be lower, their PE ratio will be lower. You're not affecting their profits by not buying their stock. You can affect their profits by not going into the casino, not smoking tobacco or drinking alcohol, but you're not doing that anyway, if that's your values, but you're not buying their stock doesn't change their price. But if lots of people don't buy their stock price or sell it, then it will lower their PE ratios, drive their cost of capital up, drive their cost of debt up, and put them at that competitive disadvantage. Now, what most people don't understand is there's a flip side to that. If you have a low PE ratio or a low earnings yield, that's a high expected return to the person who's buying your stock, right? Because you're getting more earnings for the same dollar that you put in to the stock price. Okay, so if you have a company that's trading, saying earning $10 and has a 20 PE because it's got a good ESG score, $10 in earnings, 20 stocks at 200. Another company's trading at only 10 because people don't buy it. You only paid $100. You're getting $10 back. That's a 10% return on your capital instead of a 5% return. So the standard economic theory would say if you have lower PE ratios, you're going to have higher expected returns for doing so. And that's what the evidence shows. That's why value stocks have higher returns than growth stocks historically, even though growth companies have better return on assets, higher return on equity by quite a bit, but you pay a much higher PE ratio. And you're willing to do that because those companies are higher quality, safer, more likely to have those higher earnings. Well, the same thing is true about ESG companies. There's a reason they have lower PE ratios, because they're more likely, because they have low ESG scores, to have more environmental incidents, poor governance. Maybe they don't hire the best auditors. They can't attract the best talent because they don't practice good diversity or treat their employees well. So the research is pretty clear that what you should expect, and over the long term, this has been true, ESG companies have higher returns, about 2 to 3% over the long term, but they also have more tail risk and more volatility. And so there's that higher expected return is, at least to some degree, a compensation for a higher risk taking. Now, 2 last points. One is you sort of can have your cake and eat it too by taking the approach that Dimensional does, which is says, we're going to screen for the better companies in their industries, and then we'll buy the stocks that have those low PEs, but have good scores relative to their industry. And that way we get to eat our cake and have it too. That's their approach. Second thing that I want to point out relates to what's called how the trends in cash flows can impact short-term results. So let's say that up until, and this is the history, about 2005 was the beginning of the new ESG movement, transition from SRI, and that's when the capital really started to flow into the industry. But it was a very slow transition, with maybe $1 billion or something like that every month coming in, or a few billion a year. But in 2017, when climate change became a big issue with the Paris Accords, and we started to have a lot of bad climate events, all of a sudden there was a massive inflow of capital into ESG strategies. And that drove up the prices of the good scoring companies and drove down the prices of the bad scoring ones. So what you ended up with is those capital flows created very short-term capital gains in those companies. And now you drove those prices so high that you should have lower future expected returns. And that's exactly what happened. Think of, as a good analogy, what happened in the dot-com era. Those high-flying, innovative, disruptive companies, their stocks soared in the late 90s, not because their earnings were much better, but because of cash flows and the mania to buy these companies. Eventually that bubble burst, and those very high P ratios translated into very low returns. That's exactly what happened from 2017 through 2020. Now we think that we're in the relatively early stages, maybe about the 4th inning or so of the transition to ESG. Right now, we're about 40% in the US, about 50% globally. The surveys show that they expect those numbers to keep rising for the next several decades to maybe 70 or even 80%. So we could see these cash flows continuing to overcome that, let's call it 2 or 3% higher expected return to the sin or brown stocks because of that cash flow. But we don't know that. It could be enough to maybe just match it, and so you get no worse returns, but you get this expressive value. But at some point, when we get to an equilibrium where everyone's invested the way they want, and let's call it 75% of the people are ESG investors, At that point, the bad or the sin or the brown stocks should have 2, 3, 4%, whatever is higher expected returns, but also higher risk. And again, I'll close and let Sam add his thoughts. You can sort of compromise and achieve both objectives by saying the reason that those sin stocks get higher returns is because they have those low PEs. So we could focus on buying low PE or value companies that have good ESG scores, and we can sort of have our cake and eat it too. So we think that's a good approach. Sam?
Yeah, that's the great summary of the research, Larry, and the theory of where the profits are. Now, sometimes this is confusing to people because what Larry's saying is that companies that are doing well on ESG actually have higher profits. And we kind of think of they have higher profits to themselves as the companies, right? Which means they give less returns to investors over time. Now, that seems a bit counterintuitive. So let's break that down. Most of us think of sustainability as a kind of constraint. Oh, I can't drive today, or I can't eat red meat today, or something like that, right? But in reality, companies that invest in ESG initiatives tend to be companies that are more profitable, right? So at a company level, their financials are stronger than low ESG rated companies. And that's because a lot of companies are doing ESG initiatives that are profitable. Right? Like, I would love to think that Walmart and Target are these wonderful, altruistic companies that installed, millions and millions of solar panels because they're nice people. But that's actually not necessary. What they realized was that they have a lot of flat roofs in their giant stores, and they can generate basically marginally free power going forward. And so it made good business sense to install solar panels. And that's why they're both in the top 5 solar installers in the world. There are lots of ESG initiatives, treating your employees well, keeping them safe, environmental issues that actually pay good dividends. And the way to think about it is take a look at your own life and think about some of the decisions you've wrestled with. Like, should I buy an electric vehicle? Okay, well, they're a little more expensive up front, but then I'll save a ton in gas and maintenance going forward. So do I have the capital to make that outlay now and save money through time? Should I do that with solar panels? Should I do that with insulation? All kinds of things where you need to make an upfront payment and then you enjoy the relative profits of that going forward. And that's kind of what the ESG investor is asking companies to do. They're saying, you know what, it would be great if you guys would stop looking at, the quarterly earnings cycle or the annual report and look further out and invest in these sustainability projects that will put you in better stead for the future, right? And you can imagine a company that does those things in 3 or 4 or 5 years' time, the ROI on those projects, the return on investment is coming in, and they're getting more and more profitable over time. So that's what we want as investors. We want companies to start choosing those sustainability projects that are more profitable in the long run.
Yeah, let's add one other thing on this, which is the impact that investors are having. I think we touched on it earlier, but let's emphasize it here. Because companies know that if they have bad ESG scores, people will avoid buying their stock. That will put them in a bad position in terms of their ability to raise capital at a lower cost of capital. Their debt will cost higher, putting them at a disadvantage to, when it comes to being able to invest relative to their competitors. But also, very importantly, especially in this era of very tight labor markets, if you don't have a good ESG score, you may not be able to attract employees who don't want to work for a company that doesn't have an ESG score because it's not expressing their values. And certainly, if you don't have a good score in how you treat employees, you're not going to be able to attract them. So companies are taking notice of this, and they are being forced by investor behavior to make ESG investments, treat their employees better, and their boards are pushing them to do so in order to just stay competitive. So the good news for the ESG investor is that they are clearly having an impact on corporate behavior, which is, I think, an important point to know.
Yeah, wow, thank you. Thanks so much, Larry and Sam. We are getting into bonus territory, so I do want to mention here that the book that covers so much more than what we're just talking about today, it goes more in depth. Everybody on the call right now will be getting a copy of that with a signed book plate from Larry and Sam. So we will be getting that out to all of the attendees today, so you can dive deeper into this topic, learn more, because that's where it starts, the knowledge, which is why we hold these webinars.
Hey, Justin, one thing I think be good for Sam, we didn't touch on an important topic of impact investing.
I was just about to get there.
And Sam has a great personal story he can tell about that as well.
Awesome. Yeah, Sam, why don't you go ahead and talk a little bit about impact investing in your personal story there.
So here's why I characterize impact investing as a for-profit version of philanthropy. Well, there's a lot of reasons, but there's traditionally, and this is what I used to do for a long time and recommend that advisors do with their clients, is make as much money as possible in your investment portfolio and then give it away in philanthropy. Because when you give it away, 100% of that money can be used by that philanthropy to, advance their causes. And the same idea is with impact investing. You invest in that company or that project, and they can use that capital. Now, my story with impact investing is that I like organic food and I like coffee. And so I found this kind of crowdfunding website that helped different communities around the world do their sustainability projects. And one of the projects was to get a village in Peru up in the mountains to be able to get their organic coffee bean certification. Right now, their coffee was already organic, but it wasn't certified, so they couldn't charge the higher prices. And so I contributed, I think it was $500 to this project. And after like a month or so, enough people had contributed enough money to send a couple $1,000s down to this Peruvian village, and they paid for their organic certification. And then they started charging for higher beans, higher cost for their beans, and they sent the loan back. And so the money came back, my $500 came back into my crowdfunding account. And I was looking around for another project to support. But while I was looking around in the couple of months it took me to choose, the crowdfunding business website went out of business. And so I got an email from them saying, would you like to take your investment, your $500, and have us wire it back to you? Or would you like to contribute it to the closing down costs of our little business? And I ticked the box to contribute it to them because I had a nice experience. And that's kind of where impact investing is. Your real goal is to make a change like it is in philanthropy. And if you get the money back, if you make some profits, you're probably going to pile it back into more impact projects, right? It's not really a vehicle for you to put some of your serious capital that you need your kids to go through college with or something like that into that. But having said that, it can be very impactful, right? A couple $1,000s in Peru, right? Or in sub-Saharan Africa, or in an inner city in the US can really make a significant change. But I do want to point out it's very different from conventional investing, and we should think of it separately than that.
Yeah, I mean, that's something that I've really, thought about too, because we have a lot of generous clients that give money away. And if you can invest that money based on the impact it can provide, not necessarily the economic return, you can create something so much more sustainable than a one-time gift, and have a charitable company that continues to give and give and give and make money and pour it back into the communities it serves. I think that is a much better long-term solve than just simply giving the money, which is kind of a one-time thing, and then it's used and it's done. So impact investing, I'm definitely going to be reading and researching more on that, and I appreciate you bringing to light that
So
whole
Justin,
topic.
my I don't know, it's a parable. I think it was like, if you give a man a fish, he eats for a day. If you teach a man to fish, he eats for a lifetime. If you give that man some capital to help him buy a fishing boat and hire some fishermen, he'll feed a village for a lifetime, right? And so that's kind of the step to impact investing that I like to describe.
Perfect. Love that.
Thank you. Actually, I want to follow up that question, Justin, by asking Larry and Sam. So how does an investor who's gotten all excited by this discussion today get started in either an ESG investment or an impact investment? How does someone get started with doing this?
Well, I'll take the first shot. One, you could read the book and there's a chapter on implementation. So that's a short answer. But a very simple approach for most people, at least to get started, would be to use, for example, the funds of Dimensional. They've got a great suite, a US and an international fund, so you could globally diversify. It's a best-in-class approach, which we think is the right way. And that's one very simple way to do it in a low-cost, tax-efficient way. A second approach is to work with an advisor like yourself. Through us, you have access to separate account managers, including Dimensional, Parametrics, and Aperio, who can work with you to build a portfolio that meets your very specific laid out values, where you can say, I don't want any tobacco, alcohol, whatever it might be, and lay it out, and then we'll build an individually tailored portfolio to do that. So you can go, those are the two really simple approaches that I would recommend somebody take. Sam, you want to add?
Well, that's basically what my wife and I did with our personal portfolio. In 2011, we started sustainable investing, and we call it search and replace. It's not that straightforward, but we asked our advisor, and every year or two, they would find one fund in our portfolio of about 15 funds that they could swap out the conventional one for the ESG one. I'm an ex-Dimensional employee, so there's a lot of Dimensional funds in there. And when the tax situation was right, we'd sell the conventional one and buy the ESG one. And it took a while, but now I think 86% of our portfolio is invested in sustainable funds. There's still some asset classes you can't get in ESG, so we don't throw out the diversification, we keep it. And my analogy there, you can tell I love analogies, is it's kind of like buying organic food at the grocery store, right? You got your shopping list, you got the meal you're going to make at home. You can't skip the milk, right? Or whatever. You can't skip the hamburger. So you buy it organic if it's there and if the price is okay. But if it's an extortionate price or it's not organic isn't available, you just buy the conventional and you continue to make your meal, right? You can't get to perfection yet, and that shouldn't be the goal. It's all about progress. And so, whether it's your conventional ESG portfolio or starting to look at some alternatives to philanthropy with impact, just take a slow and steady pace and get some professional help, and you'll be all set.
Incredible. David, I think you're gonna.
I'm gonna thank you very much. This was really beneficial. I learned a lot, and I've heard both of you speak on the subject a few times now, and every time I seem to learn more and more. And I hope our listeners got a lot out of it. As Justin mentioned, we're going to be sending them a copy of your book, which I also highly recommend. It's a great read, and it's written in such a way that it's very basic and easy to understand. You don't have to have a background or a degree in finance. So I do recommend it to anybody who's listening here. And I thank you for your participation today.
Thanks.
Our pleasure.
And
Thanks,
we do
guys.
Yep, we do have the 2 more webinars coming up, one in October, one in November. We'll do this every month. next one in October is on estate planning basics. So kind of what documents you need, what documents don't. We'll have a very, very experienced estate planning attorney on for that. And then in November, how to choose the right providers of extended care with Nancy Dykman, who is a certified senior advisor, nationally recognized educator about choices of where to receive extended care. So those two sessions will be equally as impactful as this one that Larry and Sam just helped to provide. So thank you so much.
Hey, Justin, on that note, the next 2 months, please make a note. They're on the second Wednesday of the month. So it's going to be on October 12th and November 9th. We usually have these on the first Wednesday, but there's conflicts on both those first Wednesdays. So we'll be on the second Wednesday. And of course, we'll be sending out emails as reminders as well.
All right, great.
All right. Thank you, everyone. And we wish you a good day.